Something happened in Japan 2 months ago that almost no one in America noticed. And it's about to show up in your mortgage payment, your 401k balance, and the price tag on everything you buy. On January 20, 2026, Japan's 30-year bond yield spiked by 30 basis points in a single trading session, the biggest one-day jump since these bonds first existed back in 1999. Within hours, the U.S. Treasury Secretary was on the phone with Japan's finance minister, essentially pleading with them to say something, anything, to calm the markets. Sit with that for a second. The United States government stepped in to help stabilize another country's bond market. Not out of goodwill toward Japan, but because whatever happens in Tokyo doesn't stay in Tokyo, it ripples straight into your wallet. Japan holds $1.2 trillion in U.S. Treasury bonds. That's more than Apple, Microsoft, and Amazon combined. They're the single biggest foreign holder of American debt, controlling roughly 12.4% of all foreign-owned U.S. Treasury securities. For 3 decades, Japanese investors have been some of the most dependable buyers of U.S. government debt. That steady buying has helped keep American interest rates lower than they'd otherwise be, cheaper mortgages, cheaper car loans, cheaper borrowing for businesses, and a stronger stock market. But that era is ending, and the unwind has already started. To understand why this matters to you, you need to understand how Japan became a ticking time bomb sitting at the center of global finance. Japan's debt-to-GDP ratio currently sits at 236.7%, the highest of any major developed economy on Earth, more than double America's roughly 125%. Picture it this way. If you earned $100,000 a year and owed debt at that same ratio, you'd be $236,700 in the hole. That's an enormous amount of debt to service in interest payments alone. Economists usually start getting nervous once a country's debt-to-GDP ratio crosses 90%. Japan blew past that mark decades ago and just kept climbing. For most countries, that level of debt would have triggered a crisis long before now. But Japan dodged that crisis using a trick that worked flawlessly for 30 years, until now. The trick was simple: keep interest rates at zero. Starting in the 1990s, after Japan's colossal real estate and stock market bubble burst, the country entered what economists now call the lost decades. In the late 1980s, Japan had lived through one of the most jaw-dropping asset bubbles in financial history. Stock prices doubled, real estate values nearly tripled. At the peak of the madness, the land under the Imperial Palace in Tokyo was famously worth more, on paper, than all the real estate in the entire state of California. When that bubble popped, deflation set in, prices actually fell year after year. That might sound like a win. Who wouldn't want cheaper prices? But deflation sets a brutal trap in motion. When prices are falling, people put off buying things because they'll be even cheaper tomorrow. When people stop buying, businesses can't sell. When businesses can't sell, they cut jobs. When people lose jobs, they spend even less. It spirals, and in Japan's case, it spiraled for decades, from the early 1990s well into the 2010s. To fight the deflation, the Bank of Japan did something no major central bank had done before. They slashed interest rates to zero and left them there. They printed enormous sums of money. They introduced something called yield curve control, essentially capping how high bond yields were allowed to rise by buying up whatever bonds were necessary to enforce that ceiling. The Bank of Japan didn't just become a buyer of last resort, it became almost the only buyer. By late 2024, the Bank of Japan owned 46.3% of all Japanese government bonds, and for certain maturities, even more. They effectively became the market itself. When you can borrow at 0% interest, even a mountain of debt becomes manageable. Japan's debt servicing costs stayed shockingly low despite the massive debt pile. It was like having an infinite credit card with a 0% APR that never expired. Except every 0% offer eventually expires, and Japan's just did. Inflation has finally returned to Japan after almost 30 years of absence. It's been running around 3%, which sounds tame next to what Americans just went through, but for Japan, it's a seismic shift. An entire generation of Japanese citizens grew up in a world where prices simply never rose, where hoarding cash made total sense, where the normal rules of economics didn't seem to apply. Now those rules are snapping back to normal, and the adjustment is painful. The Bank of Japan raised rates in December 2024 to 0.75%, the highest level since 1995. That might sound laughably small compared to US rates, but for Japan, it's a fundamental regime shift after 30 straight years at zero. The IMF expects at least 2 more hikes this year, with another to follow in 2027. More importantly, the Bank of Japan has stopped acting as the buyer of everything. They've pivoted from quantitative easing to quantitative tightening, meaning they're actively pulling back their bond purchases. They've been cutting purchases by 400 billion yen every quarter, aiming to cut monthly purchases in half, down to 3 trillion yen, by March 2026. When the biggest buyer in any market steps back, prices drop. When bond prices drop, yields climb. Japan's 30-year bond yield hit 3.91% in January 2026, the highest reading since these bonds were created. The 40-year yield broke above 4% for the first time ever. The 10-year yield climbed to 2.12%, its highest point since 1999. For a bond market that had spent 30 years anchored at zero, these are seismic moves. The spark for January's explosion was political. Prime Minister Sani Takaichi announced snap elections built around promises of tax cuts and increased government spending, specifically proposing to suspend the 8% consumption tax on food. Bond investors did the math instantly. More spending plus tax cuts equals bigger deficits, which means more government borrowing, which means more bonds flooding the market, which means lower prices and higher yields. The bond market revolted in real time. Some analysts compared it to the Liz Truss moment in the UK back in 2022, when unfunded tax cut proposals sparked a bond market meltdown that toppled the government within weeks. But here's where this stops being a Japan story and becomes your story. For decades, Japanese institutions, banks, insurers, pension funds, have participated in something called the yen carry trade. The mechanics are simple. Borrow money in Japan at near zero interest, convert those yen into dollars, invest the dollars in US Treasury bonds paying 4–5%, and pocket the spread as essentially free money. Here's a concrete example. A Japanese pension fund borrows $1 billion worth of yen at 0.1% interest, converts it to dollars, and buys US Treasuries yielding 4.5%. That's a 4.4% spread, roughly $44 million a year in profit on that single position, with very little risk as long as exchange rates hold steady. Now multiply that across every institution running this trade, add in the extra leverage hedge funds pile on top, and you get a massive river of money propping up US asset prices. Estimates of how big this carry trade actually is vary widely. Conservative figures put it around $500 billion. More aggressive estimates, which account for hedge fund leverage, suggest it could top $20 trillion. Whatever the real number, it represents a huge flow of capital that's been supporting US Treasury prices and keeping American interest rates lower than they'd otherwise be. Now run the math with today's numbers. Japanese 30-year yields sit at 3.48% this week. Once you factor in currency hedging costs and transaction fees, the spread between borrowing in Japan and investing in US Treasuries has shrunk dramatically. The free money isn't free anymore. And if you're a Japanese pension fund or insurer, you have to ask yourself, why take on currency risk and the hassle of investing overseas when you can earn nearly the same yield at home in your own currency with zero risk? Increasingly, the answer is, you wouldn't. Japanese institutions are already retreating. Life insurers cut their holdings of Japanese government bonds by 1.35 trillion yen in the 3 months through March 2025, the third largest reduction on record. When domestic institutions won't even buy their own government's bonds because yields are swinging wildly, that's a red flag. And when that same hesitation spreads to their overseas holdings, it means US Treasuries are about to lose a major buyer at precisely the moment America needs more buyers, not fewer. We already got a preview of what happens when this carry trade unwinds back in August 2024. When the Bank of Japan hinted at tightening, the yen strengthened rapidly, forcing investors to unwind their carry trade positions fast. Bitcoin crashed 23%. The Nasdaq dropped 10%. The S&P 500 fell 8%. It happened fast, and it was brutal, and that was only a partial unwind. A full unwind would hit far harder. Meanwhile, the US government is running annual deficits of roughly $2 trillion. Total national debt stands at $38.6 trillion as of February 2026. Every year, the Treasury has to sell more bonds to cover that deficit and refinance maturing debt. When a major buyer like Japan pulls back or starts selling, it pushes yields higher, because the remaining buyer's demand better returns to soak up the extra supply. And it's not just Japan. Europe collectively holds close to 40% of all foreign-owned US Treasuries, around $8 trillion. European governments are now under pressure to ramp up defense spending given current geopolitical tensions. Where's that money going to come from? One obvious option: selling off some of their U.S. Treasury holdings. So now you've got the two largest foreign holders of U.S. debt potentially turning into sellers at the exact moment the U.S. government needs to sell more bonds than ever before. Higher Treasury yields flow directly into your everyday life in ways you might not immediately connect. Mortgage rates closely track the 10-year Treasury yield. As of this week, the average 30-year fixed mortgage rate sits at 6.11%, according to Freddie Mac, already up from just a few weeks ago. The 10-year Treasury yield has been climbing too, now at 4.24%, and the recent volatility suggests more upward pressure is likely. Every 1% jump in mortgage rates on a $400,000 home adds roughly $250 to your monthly payment. Over a 30-year loan, that's more than $90,000 in extra interest. Stock valuations are sensitive to interest rates because of how investors calculate the present value of future earnings. When rates rise, future earnings are worth less in today's dollars, meaning stock prices should fall even if the underlying companies are performing just fine. Corporate borrowing costs rise right alongside Treasury yields, which means businesses invest less, hire less, and sometimes cut jobs. The whole economy ends up paying more just to borrow money. Here's something a lot of investors don't fully appreciate. The classic relationship between stocks and bonds may not protect you the way it used to. Normally, when stocks fall, bonds rise as investors run to safety. But when the real concern is a government's creditworthiness and rising rates themselves, stocks and bonds can fall together. Ken Griffin of Citadel has explicitly warned about this. Bonds lose the thing that makes them valuable in a portfolio the moment they start moving in the same direction as stocks. The picture gets even more complicated once you factor in Japan's demographics. Japan's population peaked at around 128 million in 2010. Today it's closer to 122 million and still falling. By 2050, projections suggest it could drop below 100 million. The median age in Japan is now 49. There are more people over 65 than under 15. Last year, Japan recorded fewer than 687,000 births, the lowest number since records began in 1899. Japan now sells more adult diapers than baby diapers. That's not a joke, it's a demographic reality. This matters for the debt situation because a shrinking workforce means less tax revenue flowing into government coffers, right as pension and healthcare costs are exploding. The IMF projects Japan's interest bill will double between 2025 and 2031. Even if Japan's total debt stayed frozen exactly where it is, the debt-to-GDP ratio would still worsen, because GDP shrinks when your working-age population shrinks. You simply can't grow your way out of a debt problem when your economy is structurally shrinking. So what happens next? There are three broad paths this could take. The most likely path is a slow grind. Japan carefully manages the transition over years, raising rates gradually, letting the carry trade unwind in an orderly way, avoiding sudden shocks. The Bank of Japan is sophisticated and has been steering this bizarre situation for 3 decades already. Americans would still feel the effects through gradually rising interest rates and a somewhat softer stock market, but the adjustment would be manageable. This is probably the base case, and it's what officials on both sides of the Pacific are working toward. The second path is a faster unwind, triggered by some outside shock, a geopolitical crisis, a sudden spike in Japanese inflation, or a political misstep. The ongoing tensions in the Middle East around Iran are exactly the kind of shock that could speed this timeline up, by driving oil prices higher and stoking inflation fears. In this scenario, the carry trade unwinds quickly, Japanese institutions dump U.S. Treasuries, yields spike, and markets sell off hard. The third path is a full-blown fiscal crisis in Japan, where the debt becomes completely unmanageable and the yen collapses. Most economists see this as unlikely, because Japan has real strengths, high domestic savings, a current account surplus, strong technological capabilities that act as buffers most other countries don't have. Still, the sheer scale of Japan's debt burden means we're navigating uncharted territory. No matter which scenario plays out, the direction is clear. The era of near-zero interest rates in Japan is over. The massive support Japanese investors have been providing to U.S. Treasury markets is fading, and Americans are going to feel it through higher borrowing costs across the board. So what can you actually do with this information? First, understand that your standard 60-40 portfolio might not protect you the way you'd expect. When stocks and bonds can fall together, diversifying into other assets like gold and silver may offer better protection. Gold has already surged past $5,000 an ounce, partly because investors are hunting for alternatives. Second, if you're planning a major purchase that involves borrowing, a house, a car, expanding a business, recognize that waiting could mean facing higher rates. The assumption that rates will drift back down to pandemic-era lows is probably wrong. Third, prioritize quality in your investment portfolio. Companies with strong balance sheets and low debt will hold up far better under rising rates than heavily leveraged ones. Fourth, keep an eye on the 10-year Treasury yield as a key signal. If it climbs sustainably above 5%, and especially if it nears 5%, that's a sign of significantly tighter financial conditions ahead. Japan's situation is complicated, and it's tempting to tune it out because it feels distant and technical. But the global financial system is deeply interconnected, and the flow of money between Tokyo and New York has been shaping American interest rates for decades. That flow is shifting now, and the shift is structural, not temporary. The good news, this isn't a sudden crisis demanding immediate panic. It's a slow-moving shift that will unfold over years, which gives you time to adjust, reposition, and prepare. But preparation requires awareness, and most Americans have no idea that events unfolding in Japan are about to reach into their own financial lives. The era of cheap American borrowing, propped up by foreign investors willing to accept low returns, is coming to an end. That reality is going to show up in your mortgage statement, your investment returns, and the overall cost of living. Now you know what's coming. What you do with that knowledge is up to you. It's up to you.